Year to date, the market overall has performed very strongly. We have a lot of big names that are at double digits and a lot of green across the board. In today's episode, we're focusing on 5 undervalued dividend stocks to buy now before it's too late. We're going to look at the historical performance. We're going to discuss their dividend safety. We're going to talk about the underlying supporting financial metrics, and we will run them in the valuation model so we get to our intrinsic value, our acceptable buy price, as well as looking at Wall Street and their expectation over the next 12 months. Now, the first undervalued dividend stock we are taking a look at is British American Tobacco, and this is a company that we get a double buy rating seeking alpha and Wall Street. We do see it trading towards the lower end of the 52-week range. It does have a trailing 12-month yield of 9.6% and a forward P of 6.44. Now, if you've been holding this over the last year, not performing great, down negative 14.53%. And if you've been a long-term shareholder, well, you would be down negative 49%. Bear in mind, if you were to reinvest those dividends, it would be slightly higher. And we do see all-time highs, $73, 2017, so we are talking about 7 years ago. In terms of the dividend safety score, we take a look, 45, borderline safe. Market cap, 67 billion. It is a large cap company. Now, we also note, in fact, that they did get their dividend safety reaffirmed just a few months ago, and we can see here that it does suggest there is a moderate risk of a dividend cut, so we will take a look at some metrics in relation to that. Key metrics then, specifically looking at the last recession, we do know they increased the dividend during the 07-09 crash. They had plus 4.8% recession sales, above the average. Remember, it was negative 12 for the S&P during 07-09, and recession return negative 31%, outperforming the S&P, which did have negative 55. Dividend growth, so we do see a mediocre 2% just this year. Now, we do advocate on the channel 4% or more just to keep up in line with inflation. Over the last 5 years, 3%. Over the last 20 years, looking a lot better at that 9% level. In terms of the number of years, well, they've increased the dividend for the last 24 years. When they do increase the dividend in 2025, they will enter dividend aristocracy status. Now, in terms of dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. We have a massive undervaluation signal here, and we have another one on the forward PE, 6.5, significantly lower than the 5-year rolling of 8.5, and we also note significantly lower than the consumer staples of 19.1. Do bear in mind, we don't look at any of these models in isolation and will conclude towards the end. Typically on the channel, we don't look at the earnings. It is susceptible to manipulation by management through accounting, so we draw your attention to the free cash flow, below 85% for this industry if we want to be specific. And what we do note, over the longer term, it has been below that, especially since 2018. Very, very strong. It is expected to increase, but even at the 67% level in 2024, no worries with that dividend based on the information so far. Free cash flow per share, then you do want to be investing in companies that increase their free cash flow over the longer term. As we can clearly see, nearly 3 times growth over the longer period, but do bear in mind with this company, you will get inconsistency year on year, and the expectation is for the full year 2024 for it to drop down to around 356. In terms of sales growth, what we understand is the tobacco industry. It isn't going to be like tech industry with a lot of increasing top line movement year on year. At least 3 to 7% is what we'd ideally like to see. Now, over the last few years, it has been fairly mixed. Negative 1% in 23, nice 8% in 2022. The previous 2 years, in fact, we do see it stay flat. So overall, it is very mediocre. We do like to see their top line growth a little bit stronger, especially if you do factor in inflation. Then you could argue over the last few years there has been relatively minimal growth. But over the longer period, they have doubled their top line. One thing that we love to see when we look at shares outstanding are when companies do share buybacks, reducing the share counts. What we notice for BTI, over the longer term, they have diluted your position as a shareholder, but what we can see over the more recent period, they have started to do some very minimal share buybacks, which is a good sign if you have been an investor just over the last few years. ROIC then, return on invested capital, 10% or more, just to give us faith that management are able to effectively allocate their capital. It did drop down to 6% in 2017. Now, it has started to get better over the longer term. 12% we note in 2023, so that is fairly positive. Hopefully, they can start to build on this and increase this higher and higher, especially when you look at the likes of their competitors, Altria Group, who do have a very, very high double-digit ROIC number. In terms of operating margin, we love to see this. Not only is it above 20%, operational efficiency, it's gone from 36% in 2014 to 46% in 2023, moving in the right direction. And we can also see a fairly similar story for the free cash flow margin, looking very healthy and very strong, making it incredibly attractive to potential investors. We then move on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is the measurement for tobacco companies, and remember, these are the number of years it would take the company to pay off all of that debt net of cash on hand. 2.65 in the more recent year, looking strong. 2.71 expected in the full year 24. A little bit of an increase, but still below the 3. And given the fact the free cash flow payout is looking to be around 67% this year, then so far the dividend does look to be safe. No massive red flag indicators based on this information we've just gone through. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through every single one of these models to get to the value. Today's episode, let's jump straight into it. And today, British American Tobacco, our calculated intrinsic value based on our estimates and judgments, comes to $40.10. With the current price around $30.65, we do use a margin of safety, a starting point at 10%. Remember, we only execute on 10% if it meets our 3 criteria, which are a wide moat, strong financial metrics, and good forward-looking data. So at 10%, it's a buy up to $36 if you do believe that it does warrant that. We then keep going till it's near the current trading price, and we can see in today's episode, it isn't too far off a 25% margin of safety, so you could argue 20 to 25 or 25% based on today's analysis. In terms of Wall Street and their expected price target over the next 12 months, well, not only are you getting in a yield and touching that 10% mark, but expected upside of 24% with a price target of $38, not too far off our $40 mark. As always, let us know your thoughts about these stocks as we do go through them today. Just before we do move to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others, completely free, instant access, do click on the pinned comment below. And just to let you know, for those that do ask, what are the websites we use to analyze our stocks? It is all explained in this essential article on how to find undervalued stocks, going through the best resources to help you. The next stock that we're looking at is Starbucks Corporation. Now we have a buy rating from Wall Street. However, we have a hold from Seeking Alpha and Quant Analyst. It is essentially trading right there towards their 52-week low. And when we take a look over the last 12 months, they are down negative 29%. And over the last 10 years, up 105%. We do see all-time highs sitting around July 21 of $126. We also do note now the forward yield does sit at 3% or just over, and a forward P around 20.87, not too far off the S&P average forward P of 21.5. In terms of dividend safety, well, actually it just got downgraded to a 60 borderline safe, so we can run through that now. Market cap 86 billion, a large cap company. And as we can see here, just a few days ago, they did get downgraded. Again, suggestion of a potential moderate risk of a dividend cut over a full economic cycle. In terms of the last recession, well, they didn't pay a dividend, so no comparative data. They had above average growth, negative 6% versus negative 12%, but they did underperform the S&P with their negative 69% return. Dividend growth, very nice last September, 7.5%, double digit over the last 5 years, double digit over the last 10 years, so looking very strong and healthy. Over the last 13 years as well, they have been increasing those dividends year on year, always great to see. And in terms of dividend yield theory, no surprise here, severe undervaluation both on the yield as well as the 5-year. We're looking 20 on a forward P versus the average of 29 as well. In terms, however, the consumer discretionary sector P does sit much lower at 13. Now, in terms of the free cash flow payout for the restaurant industry, we do want to see below 50%. What we noticed, 90% very high in 22, 67 in 2023, so it has come down lower. 2024 expected around 71%, so it will be interesting to see this September how much they increase the dividend, but I personally wouldn't be expecting anything more than around mid-single digit increases. In terms of free cash flow, very inconsistent over the longer term. Granted, it has increased from the 2014 negative position to 320, but year on year, a significant amount of inconsistencies and turbulence. We do know 2024 isn't expected to be far off the prior year's figure. In In terms of sales growth, well, actually pretty strong. We're talking actually better than the 3 to 7% we want, nearly double digit every single year other than the COVID year. So again, it is looking healthy, although if you did watch our latest in-depth deep dive of Starbucks, their latest quarter does show that they are struggling to increase it across the different regions. Numerically speaking, though, they have more than doubled it over the longer term, and we do also note some share buybacks over the last 10 years, which is always great to see, especially when a company is increasing their dividends at a very strong rate. In terms of ROIC, well, above 12% if we want to be industry specific for restaurants, and we can see looking very strong, 33% in the more recent year of 2023. So again, this is a very big tick, especially when looking at management as well. In terms of the operating margin, it does fluctuate around that 16% level, so something we do want to keep an eye on, especially if they do struggle to increase their top line. Hopefully they don't let their operating margin slip any further. And in terms of free cash flow, looking pretty healthy on average across the last 10 years. Last 3 years looking strong as well, above that 5% level. In terms of net debt to EBITDA, granted, we did get a downgrade to a 60 dividend safety score, but it is still below the 3.5 for restaurants, 2.06 in 23, expected to be around that in 24. So based on this information, with the free cash flow, dividend also looks to be okay. So let's jump into the valuation. As always, you can click on the pinned comment below to grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list. So a 10% MOS level, it is a buy up to $96.22, at 15% around 91, and we keep going again till it's near the current trading price. And for today's episode, it is pretty much trading at a 30% MOS level, so it does look like a very strong buy now. And when we look at Wall Street, they do see around 38% upside over the next 12 months with a price target of $103. And as always, let us know your thoughts below. We then move on to a company which is the Hershey Company. We have 1 buy rating, 2 hold ratings. Again, very similar to the previous 2 towards its 52-week low. It has a forward yield of 2.74% and a forward P, again, pretty much in line with Starbucks, so not too far off the essential S&P forward PE. But we do know over the last year, hammered down negative 27% with the increase in the cocoa prices really affecting the Hershey Company. And when we look over the last 10 years, it is up around 106%. In fact, it has fallen massively from all-time highs last May of $275. However, given the fact that cocoa prices have started to drop in the more recent period, this could really bring Hershey Company back or near towards their all-time highs not too long ago. Dividend safety score then 80, it does look to be safe. Market cap 40 billion, it is a large cap company. And when we do take a look at their dividend safety score, they were in fact downgraded not too long ago to safe. So it still does look safe. A dividend cut does still also look unlikely, but we can see before it was sitting around a 93 level. In terms of the last recession, while they did maintain the dividend during the 07-09 crash, they had pretty much flat recession sales, and they did significantly outperform the S&P, negative 30%. And look at this for dividend growth, 15% this year, 10% on average over the last 5 and 20 years. So a very strong dividend growth company with increases 14 years in a row, but also paying a dividend for the last 94 years without a single reduction. Now, in terms of dividend yield theory, we again see a very strong double undervaluation signal, 2.74 current yield with a forward P of 21, and we note it isn't too far off the consumer staples sector at 19.1. So let's take a look at the free cash flow payout. Now 59% in the more recent period. Bear in mind, my blanket rule is 60%, as that does give me faith that management are able to offer those double-digit increases that we love to see as investors. But what we can see for consumer staples, below 70, it has been below that pretty much for the majority of the last 10 years. 59 in 2023, 53 expected next year, so looking good so far. In terms of free cash flow growth, well, nearly 4 times growth over the longer time, and we do note 1040 expected around FY24, so some nice growth for those shareholders. In terms of sales growth, well, it has been fairly inconsistent. On a more positive note, the last 3 years have looked very strong. Hopefully it does continue, something we will look forward to when we do get their forward guidance. In terms of their total sales, well, they've increased it by around 50% over the longer term. And with regards to those shares outstanding and returning that excess cash, very minimal over the last 10 years, so not something I would factor in to our investment thesis. ROIC, now whilst it has decreased, we do note over the last 6 years in the mid-20s looking very healthy, especially when we want a minimum of 12%, so that is something that investors will find fairly attractive, as well as the fact not only increasing their top line over the longer term, but also improving their margins year on year, so always great to see. And again, pretty much the same when we do look at the free cash flow, even though we do notice a drop, 14% in 2023 looking very healthy. Finally, the net debt to EBITDA below 4, so we do bring it up higher for consumer staples, 1.49 in 23, 1.67 in 24 expected, so no real worries with that dividend. That is why we see that safe score, and given the fact that the free cash flow payout is expected to be in the 50%, there is no uncertainty with this dividend. So in terms of the valuation, let's get into the intrinsic value. For today's episode, it is arriving the average of these three models at $231. Now with the current price pretty much around $200 mark, a 10% MOS level would be a buy up to $208. At 15%, it isn't too far off, so we can say between a 10 to 15% level for the Hershey Company today. In terms of Wall Street, well, their expectation is upside of 10% over the next 12 months. They do see this hitting $219, lower than our intrinsic value. And do let us know if you have been picking up Hershey in the more recent period, given the fact that cocoa prices have started to relieve a little bit of pressure for this company. We then move on to a recent dividend-paying company. It is Alphabet, ticker symbol GOOGL. Now we have 3 buy ratings and 1 strong buy rating. It isn't too far off its 52-week low, and they have recently started to pay a dividend, which we will come on to shortly. Forward P, exactly or pretty much in line with the S&P 500 or thereabouts. Over the last year, up 58%. Over the last 10 years, up 543%. In terms of looking at the dividend safety, well, the score is safe, 80, although they have just recently started to implement this. And we see a yield of 0.47% and a market cap over $2 trillion, indicating a mega cap company. Now again, we do see they just initiated a dividend on April this year, and therefore they do get a dividend cut unlikely scenario, which we will take a look at through our metrics analysis. Key metrics, well, the last recession, they did have plus 8.4% sales, well above the average growth. Now, when we take a look at dividend yield theory, it isn't one that we will use in today's episode, given how recent this dividend increase is. But on a forward P basis, we can see 22.1, slightly lower than the 5-year average of 23.6, but higher than the communication sector at 17. In terms of the free cash flow payout, the only analysis we will do is say that it's expected to be 13% of FY24, indicating to me that we should see some very nice growth from this company moving forwards. In terms of the free cash flow, pretty much what you expect with this company that is a very, very strong grower. 89 cents in 2014, 5.50 in 2023, expected to grow to 6.40 in 2024. So this is really what we want to see from the companies we invest in, strong free cash flow growth over the longer term. Now, in terms of sales growth, you could argue it has started to slow down from the regular double-digit increases to their top line, but still looking strong at 9% in 2023. And on a trailing 12-month basis, we do see 12%, indicating we could see a very strong 2024 annual report. In terms of numerically, then we can see some very strong growth over the last 10 years, and they've also done some share buybacks as well. Yes, some shares they have also issued shares, but over the longer term, they have bought back over 1 billion shares outstanding. In terms of the ROIC, again, what you would expect, very strong last 3 years in the high 20s, trailing 12 months in the 30%. So a very, very strong company and management in that they are able to effectively allocate their capital. In terms of margins, well, very healthy. They have increased it over the longer term. A little bit inconsistent, but still very, very strong. And free cash flow, no worries there whatsoever. Consistently well above those minimums. In terms of looking at the other metrics, well, net debt to EBITDA, 0 across the board, essentially indicating it wouldn't even take them 1 day to pay off all of that debt net of cash on hand. Dividend safety, very strong. And when we take a look at that balance sheet, very, very healthy. Now, in terms of the analysis, let's get to it. And the intrinsic value in today's episode is $196 with a current price of $168. Margin of safety at 10%, a buy up to $177. At 15%, pretty much $167, so pretty much around the current price. So in today's episode, we see a 15% MOS level for Alphabet with upside of 16% expected from Wall Street analysts with their buy target over the next 12 months, or in fact their targeted price at $194.83. We then move on to a REIT, Real Estate Investment Trust Company, American Tower Corp. We have a double buy rating and a hold from Quant. It is sitting in the midpoint of the 52-week range with a trailing 12-month yield of 3.49% and a P to FFO of just under 18. Over the last year, well, down negative 4%. Over the last 10 years, though, we can see up 111%, and all-time highs do sit around 3 years ago around the $300 mark. In terms of dividend safety, well, healthy at 78, it does look to be safe. Market cap 87 billion, a large cap company, and we can see it was reaffirmed a couple months ago. Dividend cut does look to be unlikely. In terms of key metrics, well, last recession plus 8% sales and did also outperform the S&P negative 37. Very nice dividend growth, double digit over the last full year, double digit over the last 5 years, double digit over the last 10 years. This is one of the best REITs in terms of those dividend increases year on year, and we can see 11 years of consecutive increases as well. In terms of dividend yield theory, well, we get a very, very strong double undervaluation signal, 3.48, well above the 5-year average, forward P to FFO 18, well below the 5-year 25.3, but we do note the real estate sector does sit a little bit lower at 14. Now, this is a real estate investment trust, so free cash flow is a lot more volatile, so we draw your attention to the adjusted FFO, funds from operation. Below 90% is the preference, and even though it has been increasing, still significantly below that, 62% still looking healthy for full year 24. In terms of the AFFO per share, similar to when we analyze free cash flow, we do want to see consistent increases over the longer term, and we do know that it has pretty much more than doubled over the period. 2024 expected to increase as well. In terms of the percentage, we do see a little bit of inconsistency, in fact a drop in 2023, and we are expecting a low single-digit increase into the full year around 3%. Sales growth for REITs 5 to 10%. It has started to slow down, so it will be interesting to see their guidance for FY24 and see whether or not they can kickstart those double-digit increases we have seen over the last 10 years. Numerically speaking, though, they have nearly tripled their top line, and this I'm very impressed by. The reason for this, with REITs, they will dilute your position at a very quick rate. It is just the way they work, as they do retain a little of that internally generated cash flow after paying those dividends. So this is very impressive. Do check out our other episodes on REITs, and you will note that they do increase this very, very quickly. In terms of ROIC, looking very healthy as well, because for REITs we look at 3 to 5%. Nice to note around 5 to 6 over the last few years, right there at the upper end of our target. In terms of operating margin then, looking fairly healthy around the mid-30s consistently year on year. And when we finally look at the net debt to EBITDA, which does correlate, remember, to the dividend safety and balance sheet strength, we do know over the more recent years below 5.5, 2022, 2023, and it is expected to be around that level in 2024 as well. So let's look finally then at the intrinsic value, and remember, if you do enjoy the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of this model, do click on that pinned comment below. So margin of safety then for American Tower Corp, we start off with 10% and we can see a buy up to $202. At 15%, a buy up to $191. At 20%, it isn't quite there yet. So in today's episode of AMT, we do see just over a 15% margin of safety. Now, in terms of Wall Street and their expectations, well, they see upside of 21%, and as we can see here, their price target of 225 is pretty much in line with our intrinsic value, and again, indicating a good, strong buy for the portfolio. As always, let us know your thoughts in the comments below. Have you been buying any of these over the more recent period? Are you adding them to your watch list? Or maybe for whatever reason, you just don't like these? Let us know if you enjoyed today's episode. Smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.